All right. My name is Chris Campbell. I'm a practicing CPA and I work with small to mid-sized businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So today's tidbit is for my hedge funders, those in private equity, venture capital, and it deals with the ability to deduct investment interest. So there are specific rules about the ability to deduct investment interest for hedge funders, private equity folks, those that are in the business of investing money for a return. And it applies to a lot of these folks because a lot of times they may take on some debt investments. So you take on debt to make money, but then you have to pay back interest on that money. Hence, that will be defined as investment interest. You have some issues or special rules that apply when you have to pay back interest on debt. This came up with one of my VC clients the other day, and they were looking to get involved in a debt instrument, but they were unclear about the ability to make deductions because a lot of times venture capital, you're paying a lot of interest on something that may or may not either have a return or the return is later on down the line. So a couple rules that keep in mind taking on this investment and looking to pay the interest. So understand that when you are borrowing money for investment purposes and you have to pay interest back on that money, your ability to deduct that interest is based upon your investment income. It's limited to your investment income because of the vehicles that private equity venture capital folks use. They usually invest through partnerships. The way that partnerships work is that partnership or the management company or fund or whichever the operating vehicle they use may pay back the debt. But as a partner in a partnership, they have to pay their share personally on whatever that fund or investment vehicle does. So I'm talking in the context of this investment interest and income trickling down from their vehicle onto your personal return. So when you have your share of the investment interest that your fund or your vehicle had to pay, you are limited on your deductions based upon your investment income. To keep things simple, let's say that you have $10,000 in investment interest that you wind up paying out as it flows down to you personally. You're like, all right, great. I can take that $10,000 deduction. However, you are limited to the amount of investment income you can deduct. So if you have $10,000 of investment interest, you need $10,000 of investment income to offset it. If you do not have that investment income to offset it, you don't lose it, but you can't use it in that year. It just carries forward until you do have the investment income to offset that investment interest. And because what happens a lot of times is you may keep paying interest on something that may not pay off for quite some time. You may not have the income to support that deduction, at least in the short term. It may take a long time to come to fruition. Now, the other key thing is I said investment income. There are a couple of nuances associated with what is considered investment income. With investment income, there can be a number of things, but there is a twist. So interest income, dividend income, those are pretty straightforward. The twist here is capital gains. So for the purposes of determining investment income to deduct the interest against, only short-term capital gains apply. Long-term capital gains do not apply as investment income to deductions. So you have to keep that in mind. Now, what's the difference between long-term and short-term capital gains? The difference is usually defined by 1 year. If we take it from a simple standpoint of owning a stock, if you own a stock for less than a year, buy it and sell it within 365 calendar days, it's considered a short-term capital gain. If you hold that security for longer than 1 year, and that's deemed a long-term gain. Now, that's normally what's defined as a capital gain. So if you have any other regular stocks that this happens with, then fine, you follow that rule. One exception that really applies with venture capital, private equity folks, carried interest. So those you don't know, the carry is pretty much when a fund may exceed expectations and returns a certain amount to the initial investors. And once that goal is hit, the management company gets additional money and gets an additional return. That's defined as a carry. depending upon how well a private equity firm or venture capitalist performed, and the carry comes into play and gets paid out. Now, carried interest is treated a little differently. For the purposes of determining investment income, carried interest is indeed long-term after 3 years, not one. And with many funds, that usually hits unless you just have a high-flying fund, because normally when you have your private equity or VC funds, it may take a little time to hit those benchmarks because you have to provide a certain return to your investors before the carry kicks in. And that takes time. These funds usually have a lifespan of anywhere from 5 to 10 years. So for the most part, for what I've seen, when the carry does kick in, it could be well after a 3-year mark. But the point being that if you do get carry within 3 years, for this purpose of determining investment income, it's still considered the short-term capital gain. After that, it goes to long-term gain. So again, we want to make sure that we're sticking with just our short-term capital gains that count. Long-term does not. Now, let's say that you have a bunch of long-term capital gains here, and there's some investment interest that you'd like to deduct, but you only have a bunch of long-term capital gains here. You can make an election to treat your long-term capital gains as short-term capital gains. Now, most of the time, that doesn't make much sense to do because your short-term capital gains are taxed at a much higher rate than your long-term capital gains. On the federal level, the most you're going to pay is 20%. Even if you're at the top tax bracket, you're only going to pay 20% on the long-term capital gains. So long-term gains are much more optimal because your short-term capital gains are treated just like any other income. So if you are at the top bracket at 37%, you could be paying 37% versus 20. That's a pretty decent swing. So it's usually more advantageous to stick with your long-term gains. However, if you're in a scenario where you have a bunch of investment interest that could offset that income, if you were to decide to convert your long-term gains to short-term gains, then it may make sense to do that, because if you can wipe out all of those gains with your investment interest, then it's a win-win. It is an analysis that you'll have to do to determine what would be the best approach, because you may want to ride it out, pay the 20, or maybe ride it out later on where you know the big gains are going to be a lot larger in a future year, and then you may want to convert those on a future years. There's a little bit of tax planning that you would have to do depending upon what your investment gain outlook might be on the future that we have on your horizon. So a couple things to consider there. Hopefully this was helpful. Just some things to keep in mind when you're in that world. I'm investing money to big one. So if you have any more questions about this topic or any other tax or accounting related questions or issues, feel free to reach out. I'm happy to help. So that's all for now, and I'll talk to you in the next one.